Over the years, we've gotten a lot of questions from individuals we work with regarding what is the best policy design, meaning someone's interested in a whole life insurance policy specifically for maximum cash value, and they ask, hey, what's the best way to design this policy so I can have as much cash value from start to finish? I see this 1090, which is a 1090 split. That means 10% of their payment is directed toward the premium, 90% toward PUAs, but then I hear 30/70, 40/60. There's all this information, and I don't know which way to go. And sometimes I hear that if I go with a 1090 design, the policy could blow up, that it could mech, that I could just have huge regrets down the road and wish that I never started it in the first place. But then when I look at the numbers, boy, does a 1090 give me a lot more cash value guaranteed right out of the gates, often more long-term as well. And I'm comparing them and thinking, okay, like why would I go with a 30/70 if all things are equal and the policy won't mech? Like what's the reason why we often see and hear a 30/70 pushed or these designs with higher base premiums for individuals that have a specific goal of maximizing their cash value? Like that's why they're interested in the policy, to maximize the cash value and then potentially use it. So today we are going to speak to a lot of those individuals that have those questions. What design should I go with? Why am I being recommended a 30/70 design? Why am I being shown smaller companies when you, Steve, you and your company say the major mutual companies have produced higher cash values for policyholders? You, Steve, say the major mutual companies are typically used by corporations and wealthy individuals who have whole life insurance products, which is true when you look at the data. So we're going to speak to a lot of those questions. We're going to cover quite a bit in this video, really 4 main points I'm going to hit on. We are going to look at a policy analysis here. And in this analysis, we are going to cover the following. Number one, company selection. Does it make sense to go with a large mutual life insurance company? So we've got your 4 major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. When you look at those 4 companies, they have consistently delivered strong cash values to policyholders based on actual results, not just illustrations, but we've seen them consistently deliver. That's why I've got such a high degree of confidence in their whole life insurance products for policyholders, because I don't have to worry about coming back to someone and explaining why the policy has underdelivered compared to what was projected, which has always been an issue when it comes to whole life insurance, particularly cash value sales. So does it make sense to go with a large mutual company with this, guys? This is a technical term for some. If you're doing a lot of research, you know what this is, this OYT rider, which stands for 1-year term insurance rider. We've got a video series that provides a full breakdown on this. In summary, it is a rider that can be attached to a whole life insurance product, which opens up a ton of flexibility. With this rider, when you attach to policies with Mass Mutual and Guardian, what it does is, 1, it typically increases the PUA limits so I can add more money to the policy, and 2, it creates a ton of flexibility where I can adjust my PUA payment amount without having to go through underwriting. All companies have different rules and such, but we can get a ton of flexibility with this rider. I'm a huge fan of it. And I've got a renewable cost that increases over time. We're going to hit on that in this video as we go through some examples. But when it comes to maximizing cash value and copying specifically what corporations do, this rider is used by them, has been for a long time. And then an objection we hear from some that don't like this rider is that it's bad, that it can result in a policy blowing up. I strongly disagree, as long as you know what you're doing from a monitoring standpoint. But company selection. Should you go with a large major mutual company, or do you go with a smaller company and perhaps a level term rider? We hear this quite a bit, that this is the preferred design. So we're going to compare them side by side. Number 2, policy design. We're going to look at a 1090. We're going to look at a 30/70. We're also going to look at a 397 with one company, because we can actually get it that low with that company. That'll be fun. Cash value performance, looking at the guaranteed values and the non-guaranteed values on illustration. So if I take one company, let's take a small mutual company with a level term rider and look at a 1090, look at a 3070, look at a 397. Which one gives you, the policyholder, more cash value? Which one benefits you the most? Not the agent, which is what I want to hit on the last point. So we've gotten questions on this for years, like why are people recommending higher base premium designs with smaller companies? Could it have to do with the commissions? And it could be. This is something that I don't always like to talk about for a number of reasons. I never want to come off like I'm attacking someone else or anything like that, because that's not the intent. However, we've gotten this question enough times over the years where we are going to provide full transparency around what the commissions are with these different comparisons with larger mutual companies compared to smaller mutual companies. So if you're being shown comparisons with different products and companies, you know exactly what your cash value will look like. Or I should say the guaranteed and non-guaranteed illustration, you'll see exactly what that looks like. But then also you'll see what the agent is receiving in compensation. So let's get on into it, shall we? What we will begin with is company selection, point one and point two here, company selection and policy design. We'll start with a smaller mutual company with a level term insurance rider. What we've got here is the same product with the same company, 40-year-old individual, funding a policy with $100,000 per year for 30 years, up until the age of 70. On the left, we've got a 30-70 split. In the middle, we've got a 10-90 split. And on the far right, we've got a 397 split. It's about a 3.5% base premium, but it is as low as we could drive it in this particular example. Now, what I also want to hit on here is validation. When I say validation is how do I know that these values are actually from the life insurance carrier? So, like we always do here, we pull them directly from the life insurance illustrations. Let's take a look. So here we go. This is our 3070 design. I'll scroll down to show you exactly where we can see that just from a validation standpoint. But when we look at the values, what do we see here? 100K per year going into the policy under contract premium. We've got the guaranteed values and then the non-guaranteed values based on the present dividend scale. There's my net cash value. Premium outlay, 100K per year. So most important question to ask is what? Where is the money going? If I am giving tips or advice to a relative of mine, that's what I'm going to ask. Where's the money going? In order to ensure the policy is set up for maximum cash value, for your best interest, not the agent's. So here we go. When we look at this guy, what do we see? A nice breakdown as to where the money's going. Here's our base premium. So under base policy, $30,000. Then we see a 30-year term rider. This is a level term rider, so $550,000 term rider, just about $831. That's the guaranteed premium each year, so that will not increase, and it's level for 30 years. And then we've got the PUA rider for a total of $100,000. So that is the net out of pocket, and we're just consistent with the payments here, years 1 through 30. Okay, so we've got that guy. Let's go back to the spreadsheet here and compare them side by side. So first and foremost, this is based on the non-guaranteed values. So up here, we've just got split study with level term rider. This is all dividend values here. What do we notice here? 3070, you paying $100,000. What does not show up in cash value in the first year? This is a traditional whole life insurance product. The base premium is not showing up in cash value in the first year. That's taking the biggest bite out of cash value right out of the gates. So you're paying 100K, you've got just about 74,000 here. Next year, you're paying 100K again. It grows from 73, call it 74 just about, to 152. If you had $73,000 under a mattress or a 0% bank account, and you added $100,000 to it, what would happen? It would grow to 173. However, we got less back than what we paid in. So we paid in 100, went from 73 to 152. What's the worst years about a whole life insurance policy? First and second year. Year 3, 100K goes in. got just about all of it back, more and more back each year. Break-even point, year 7, meaning you've paid in $700,000 total over 7 years, and you have $700,000. And keep in mind, these are based on the current dividend values. Then we've got our 1090 split. This is with the same company, by the way. So the exact same smaller mutual life insurance company. This is not one of the major mutual companies. $100K per year going in. First year cash value, $89,000. Base premium, $10,000. We needed a larger term rider in order to push the death benefit up and prevent a MEC from occurring. None of these policies are MECs from start to finish. 100K per year goes in. What do you notice here? Well, first off, year 1, you've got significantly more value, just about 89% when we look at it here. So great upfront cash value. Year 2, you pay in 100, went from 88 to 182, so not quite all of it back, but does look good here, better than the last one. And then positive by year 5, meaning you've paid in 500 and you have more than 500. Now, as we lowered the base premium as low as we could with this particular product with this company, now what do you see? $3,500 base premium, higher term rider premium, because we have a larger term rider here. In fact, let's take a look just real quick at the illustration so we can see the actual breakdown. So there's your first year cash value, $93,000 and change. That will match the illustration, or the Excel sheet, I should say. When we go down here, what do we notice? $3,500 base premium, term rider, $1.2 million, term premium, $1,800. Okay, perfect. Back to the Excel spreadsheet, breaking even year 4. That is fantastic. Now, do you give anything up long-term here? This is the same company. Keep that in mind. Down to year 30, when we stopped funding it here at the age of 70. Which one do you have more money with? Which one? That minimum base premium example, just about 5.6, whereas with the 3070, you've got 5.46. So there's a difference there of north of $100,000. It's just about 130K. This is based on the dividend values. Let's look at the guarantees. So again, same company, same product, everything's the exact same illustrations we just saw before, but we just pulled it from the guaranteed side of the ledger. So this is absolute worst case scenario. And what do we have? Look at your 3070. 100K goes in, $66,000 and change in the first year. 1090, just about $85,000 in the first year. 397, pushing that base premium as low as we possibly could. $90,000 in the first year. What is highlighted in yellow represents your break-even point. So what do you notice here about that 3070? Takes about 25 years to break even. Now, it will do better than this. It always has. However, this is an absolute worst case scenario over here based on the guarantees. What happens when you reduce that base premium, which reduces the bulk of the expenses, and it also significantly reduces the compensation? What happens here? Well, now all of a sudden your break even has been drastically improved. Instead of about year 25, you're at year 14. What happens if we set it as low as we can? Now all of a sudden, we're just about year 10. Same product, same everything here, same health ratings, everything's apples to apples with the exception of the product design. We're reducing the premium based on the limits that the carrier and IRS offers with the MEC limit and juicing that cash value. So if this is you, which one would you like? Let's look at it long-term too, by the way. And if we look at year 30, how much was the difference in the non-guaranteed, the dividend values? About $130,000 difference. How about here? 3070 compared to that 397, it is huge there, about $450,000. How about this guy? Or about $350,000 with a 1090. Point is, lowering the base premium improves the cash value. And these are all illustrations. It's all hypothetical. The biggest selling point, in my opinion, is when we look at actual data, which is not on an illustration. We've seen low base premiums deliver the strongest cash values. And I've seen it the most from the major mutuals, which is why my comfort level is there. So this is all with the smaller mutual company. Going back to that. So we've at least checked that box off for now. The smaller mutual company with a level term rider. Policy design, we hit on that with the different designs, 1090, 397, and 3070. We're going to look at another 1090, but that will be with the larger mutual company with a 1-year term rider. And we analyzed this partially. We'll continue to do that with the comparison, and then we'll close with the compensation. Back to this. Let's look at a comparison, because the specific question people have, because this is their money going into a policy, is why am I being recommended a smaller mutual company with a level term rider over a major mutual with a 1-year term rider? Like, am I missing something here? Because the numbers are telling me to go with this because I've got more value. So here, 1090. With one of the major mutuals. You probably be able to figure out what this is if you've watched any of our videos before, compared to that small mutual with a level term rider over here. So there's the 30K base premium. There's the level term rider premium, which does not increase for the 30-year period. And then the balance is being paid into PUAs. Over here with a 1-year term rider, what's a 1-year term rider? It's a 1-year renewable term rider, which means each year that we keep that term rider on, the cost gradually increases. Now we can design it for funding for a short period of time where this cost will actually decrease. We can buy the term down more aggressively, or we can reduce the term or chop it off altogether after 7 years. However, in this case, if we want to fund for a long period of time, we do need to keep it on there. But here's what I'll add about this. A lot of times attention is given to this number that's increasing. And it's important. Our 1-year term rider series hits on it. But for this video, I'm going to encourage you to ignore it. And here's why. Not that I want to ignore data. The reason why is your cash value column reflects the costs of that 1-year term rider. So anytime we're being shown a comparison, if someone tries to point to other PUA fees or term rider costs, like, okay, I appreciate that, but the cash value reflects it, correct? Yes, it does. That's why I see the term net cash value or total cash value when I'm looking at the numbers. So here we go, 100K in, first year cash value, $92,000 and change. This is a high upfront cash value policy, a HEC V. $92,000, which in the first year is an $18,000 difference there. Between years 4 and 5 is my break-even point. And this is comparing the 1090 to the 3070. We also ran a separate comparison with the 397 and 1090, and long term, this one did produce more value, guaranteed and non-guaranteed. I did want to add that though, because if I'm watching this, I would have that same question. So far right, CV difference. This displays how much more or less you have in cash value with this design compared to the smaller mutual company over here with the higher base premium. Both policies are non-MEX all the way through. Both policies accept $100,000 per year for 30 years all the way through. With the 1-year term rider, we can continue beyond year 30. With the level term rider, we cannot. Once that term rider falls off, the longest it can be in this example is 30 years. Once it falls off, I will be restricted on how much I can add into PUAs per year. But aside from that, 30 years in, $200,000 difference. Now, the one thing that I don't like about this is it's based on dividend rates, right? Because the major mutual company has a higher dividend rate than the smaller mutual company right now. So let's take a look at the same thing, but the guarantees. Now it'll be fun. Well, that'll be interesting, I should say. So as we take a look at this, and again, if your goal is to maximize cash value, which one gives you more money? First year difference. What do you notice here based on the guarantees? 1090 with that major mutual design, $90,000. With the 3070 design, $66,000, $24,000 difference right out of the gates. The business owners and real estate investors we work with View that as an opportunity cost. If I'm going to put money here that's right now in cash, how do I minimize the upfront so it makes sense because I like the long-term benefits, but that upfront needs to be minimized. The upfront hit, I have to be comfortable with it. So the more cash value I have, the better. A lot of times I'm not even accessing all of it in the beginning, but it's important to have it up there or have it there up front. Break-even point here, between years 11 and 12, when we look at it, paid at 1.2. I have 1.2. At 30/70 with the smaller company, not until year 25. What's your difference now at age 70? $436,000 difference. How about as time passes? And this is the guaranteed values with both carriers here. Like everything is a clean comparison. And why we're showing this 1090, a lower base premium, which will give this more cash value guaranteed every single time compared to the 30/70 over here, is this is typically the specific question we get from folks reaching out saying, hey, like my goal is maximum cash value here. What am I missing? So stronger cash value over here. And look at the 1-year term cost. I almost forgot to explain this. What do you notice here? Look at year 10, you're at 44.20 on the guarantees. Go back to the non-guarantees. Year 10, you're at 18.27. The costs are higher here based on the guarantees because the company reserves the right to increase that term rider charge. However, the cash value reflects those increased costs. This is the net cash value pulled directly from the illustration and software. If you're working with us, you know that because we've sent it to you. We can send it to you, no problem. And there's my value over time. So, why the difference? Why is this recommended? And we hear things such as this policy will blow up because of the term rider needing to be supported by dividends. Here, there's no dividends being paid, and it's perfectly fine all the way through. Like there's no difference here. The term rider does not blow up, does not mech, no issue. Exactly how we set policies up for corporations. Like what's the difference here? Or why is it being recommended? This is what a lot of people are asking, what's the commission here? So let's take a look. As we look at the compensation, here is the smaller company with that 30/70 design. And this is based on the maximum commission rates. So if you're working with an agent who has been in business for a while and produced a decent amount, they will likely be at the highest rate. And what I'll add is if they're not at the highest rate, your policy will perform the same. So if a broker or agent is at the top or the max commission level, what the insurance company pays them via a rate does not impact your policy performance. It's the policy design that impacts your performance. The company is really paying the broker a commission for bringing them business they otherwise would not have had. So those different rates don't impact your policy performance. However, they do incentivize agents, that's for sure. And why I say that is with smaller companies, they will pay much, much higher rates, particularly on base premium. This company tops out at 136% of whatever the premium is. So a $30,000 base premium here results in what? 136% of that is a $40,800 total commission. Maybe an agent is splitting business with another agent, so they claim my commission's less. It's like, just tell me the gross rate. That's all I want to know. So we know exactly if there's any additional incentives or motives behind the scenes. The term rider, so this is a level term rider. Level term riders pay a commission in the first year. So here, this one pays 60% in the first year. PUA payments. This company actually pays a little bit more than 5% at the top level. We just rounded off, made it a clean 5%. There's the PUA comp. And here's the annual commissions, what the broker is receiving each year. And this is the total over 10 years. Beyond the 10th year, small commission amounts can still be paid out, but typically with life insurance, the bulk of compensation is paid in the first year, but really over the first 10 years when renewals are paid. So this is the compensation pulled directly from the grid with this life insurance carrier. Like this is what it is. Now, looking at the major mutual carrier, and this is a high early cash value product, which pays less upfront. Full disclosure on the rates. So we've got the design, the base premium. PUA rider, we have a 1-year term rider attached. Why it's not here is because the commission rate on a 1-year term rider is the same rate as the PUA rider. So it's not higher like a level term rider. So PUA rider, $90,000 per year. PUA rate, 2%. Base premium for the first 5 years with this product is 18.7%, which comes out to what? On the $10,000 base premium, what do you notice here? This includes the PUAs as well, $36.70. I'm sorry, the total base premium, $18.70. That's the first year compensation of the 10K base. If I increase it to 30, what would I have? Significantly more. But we won't do that because that harms the client's cash value. So here we go. The excess rate we can ignore with this product. There's no excess premium or target premium, nothing like that. PUA commissions over here, 2% of $90,000 is $1,800 per year. There's the annual compensation. There's the total compensation. And if this funding period was shorter and we used a different product with the same company here, the commissions would be less over 10 years. Would be a little bit more upfront, but it would be less over 10 years. My point is, look at this. So with the design, if we go back to this guy, this is the guarantees, which one gives you more money? Yeah, it's pretty clear, that 1090 design. Compensation, however, over 10 years, this is the total gross amount that we receive. This is based on our scales, our rates. Just about $33K. Versus that $30.70 with the smaller company, I would make significantly more than that in the first year alone. $44,000 in change, let alone over 10 years, $105,000. So when we keep hearing that a $30.70 or a higher base premium with a smaller company is better for some reason, such as a 1-year term rider blowing up, or you won't have the flexibility to continue to make PUA payments for a long period of time, I've got a hard time really believing that's the reason why. And for years, that has always crossed my mind, but I kind of just said, nah, poo-pooed it, because I don't think people do that. I could be wrong. But when we look at it, it's significantly more in compensation when we look at the commissions here. So hopefully this helped just with respect to providing transparency. And this is a very, very specific question when people are looking at policy design. If you are being shown a traditional whole life insurance policy and scale that premium up to 100% and nothing into PUAs, you can probably put everything together and you know what'll happen with respect to the compensation. But in any event, I do hope that this was helpful. If you have any questions, please leave them in the comments below. Please hit that like button, subscribe for more if you enjoyed it. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.